Welcome to the Deep Dive. We're here to cut through the noise and get you informed fast. Today we're doing something a little different. We're looking beyond the headlines, uncovering a bit of a contrarian playbook.
Right, finding opportunities when maybe others are looking elsewhere.
Exactly. Spotting value when the market's overall performance might be, well, blinding people a bit.
Interesting.
And this deep dive is really for you, the learner. We want you to quickly grasp the key ideas without feeling buried in jargon.
Yeah, digestible insights.
Our mission today, to really dissect a specific investment idea and look at 3 companies the source highlights as fitting this mold. Some surprising details there.
Okay, so the source material we're looking at, it presents this interesting angle on dividend growth stocks to buy on the dip.
Right.
It basically outlines a strategy, how to find potentially undervalued stocks, even when the S&P 500 is, hitting new highs.
And central to this is a concept the author uses called the Gardner-Kretzmann continuum. It's not just about buying stocks randomly.
No, it's more methodical.
It's about building this foundation, these core holdings, quality businesses you add to over time, ideally aiming for 1 stock per year of your age, creating this compounding engine.
It's a long-term view, and what's really striking in the analysis is this paradox, right? The S&P 500 is up, reaching new peaks, but these 3 specific stocks, which the author calls oft-ignored dividend growth stocks, they've actually pulled back quite a bit. We're talking 19% to 26% down from their recent high.
Oh, okay, so quite a divergence.
Exactly, and the author sees that divergence as the opportunity.
Okay, let's definitely unpack this then. Why these specific stocks? Let's dive in.
Sounds good.
Let's kick things off with the first one, Zoetis. Can you maybe set the scene? What is Zoetis all about?
Sure. So Zoetis is really a top dog in the animal healthcare space.
Okay.
They do medicines, vaccines, diagnostics, even genetic tests, precision animal health solutions too.
For pets and livestock.
Yep, both. Companion animals, dogs, cats, and also 6 species of livestock. Pretty comprehensive.
Now, here's where, for me, it got really interesting. The analysis connects Zoetis' performance to this huge megatrend. What is that?
Right. The humanization of pets. This idea that we treat our pets more like family members.
We spend more on them.
Exactly. And that trend, according to the source, previously pushed Zoetis' valuation way up. We're talking an average of 47 times free cash flow over the last decade.
27 times FCF. And FCF is basically the cash left over after everything.
Pretty much, yeah. Cash after operating costs and investments. Pure profit available. And, well, the source suggests 47 times was probably a little too optimistic.
For a company growing sales in the high single digits.
Correct. Which helps explain why it's seen that 19% pullback from its highs recently. The valuation got a bit ahead of itself, perhaps.
Okay, so if 47 times was too high, why does the current level, around 31 times FCF, look like this once-in-a-decade opportunity the author mentions?
Well, 31 times is definitely more reasonable, historically speaking, for them. Plus, its dividend yield at 1.2% is apparently near its all-time high. So that combination, lower valuation, multiple plus higher yield, makes it look much more attractive now.
And the fundamentals are still strong.
Oh, yeah. Very strong. The source notes 17 blockbuster products, each pulling in over $100 million a year.
Wow.
And crucially, its return on invested capital, the ROIC, is an impressive 22%.
And just to clarify, ROIC tells you how well they use their money to make more money, right?
Exactly. For every dollar they invest back into the business, they're generating 22 cents in profit. It shows management is pretty effective at funding growth.
That is strong. And the report mentions some pretty eye-popping long-term growth numbers, too, especially FCF and dividends.
It did. Over the last decade, FCF grew 28% annually, and the dividend grew 18% annually.
Huge compounding.
Absolutely. Makes it a top-tier compounder and dividend growth stock, as the source says. And get this detail.
Yeah.
Investors who bought Zoetis back at its IPO and just held on, they'd now be getting a 6% yield based on what they originally paid.
6%. That really shows the power of holding and dividend growth.
It does. Long-term compounding in action.
And how are things looking more recently? Product lines performing well?
Seems so. The latest quarter showed their parasiticides, dermatology, and pain products. Each grew sales over 10%. So continued momentum there.
Okay. So for Zoetis, the story is market corrects an arguably high valuation driven by a mega trend, potentially opening a door to buy a fundamentally sound business, a classic core holding type maybe?
That seems to be the argument, yes.
All right, let's shift gears. From animal health, let's talk about cooling off. Pool Corp, what's their deal and Why has this historical winner stalled out lately?
Right, Pool Corp. They're the world's biggest distributor of pool products, and yeah, historically, an amazing investment.
The source called it a 449 bagger.
Yeah, 449 bagger since its 1995 IPO, meaning $1 invested turned into $449. Incredible run.
But it's hit a wall the last 3 years.
It has. The share price has pretty much stalled out.
And the analysis talks about a confluence of factors hitting them. What are those headwinds causing this dip?
It's kind of a perfect storm for them right now. You've got higher interest rates making financing expensive.
Okay.
Fewer new homes being built in the U.S.
Right.
And just general weakening consumer confidence. People are maybe holding off on big discretionary spending like a new pool or major renovation.
So new pool construction,
Yeah.
renovations, orders are down significantly.
Dramatically, according to the source, yes.
But despite that cycle, the source argues Pool Corp is actually quite resilient. How? If new builds are down.
The key is where their sales come from. About 64% of their revenue isn't from new pools.
Oh, where's it from then?
It's from non-discretionary stuff. Maintenance and repairs. Think chemicals, replacement parts, filters, the things pool owners have to buy to keep their existing pools running.
Ah, okay. So that's recurring revenue.
Exactly. And that recurring part adds this valuable layer of safety, kind of a buffer against the cyclical downturn in new construction.
Got it. So that explains the stability. How's the financial health overall then?
Still pretty solid despite the headwinds. They generated almost $500 million in free cash flow over the last year.
Even with the downturn?
Even with the downturn. And they've been using that cash smartly, buying back their own shares while the stock's down about 23% off its highs.
Buying low, essentially.
Right. Plus, their long-term average ROIC, return on invested capital, is around 18%. That shows they know how to navigate these cycles profitably over time.
Okay. And what about the dividend? You mentioned Zoetis' yield was near highs. How about Pool Corp?
Pool Corp's yield is now 1.6%. That's actually its highest level since way back in 2012.
So, attractive yield historically. Is it sustainable?
Seems very sustainable. Here's the key. That dividend payout, it still only uses about 38% of their free cash flow.
Oh, wow. So even in this tough environment, they have plenty of SCF left over after paying the dividend.
Loads left over, which suggests there's ample room for future dividend growth once things pick up again, making it another potential long-term core type holding.
Right. So for Pool Corp, the insight is that steady maintenance revenue provides resilience, letting them weather the storm, buy back shares, and keep the dividend safe with room to grow.
That's the takeaway, yes.
All right, fascinating stuff. Now let's hit the road for our final company, Old Dominion Freight Line. First off, what exactly is an LTL hauling specialist?
Okay, so Old Dominion, they specialize in less than truckload freight, or LTL.
Less than truckload.
Yeah, unlike a full truckload carrier that takes one big shipment from A to B, LTL carriers like Old Dominion pick up smaller shipments from lots of different customers.
And combine them.
Exactly. They consolidate them onto one truck, usually using a hub-and-spoke network system. It's generally more complex logistically.
Got it. And they've also been a big winner long term.
Oh, yeah. Another huge one, a 305 bagger since its IPO in 1991. So $1 back then is worth $305 today.
Incredible. But like Pool Corp, it's hitting a rough patch, described as cyclical.
Very cyclical, and yes, it's definitely in a rough patch. The source says it's currently in the midst of a freight industry recession.
A freight recession. Okay. What's driving that, and how much is the stock down?
The stock's dropped about 26% from its yearly highs. It's mainly due to weak industrial shipments. Factories just aren't shipping as much stuff, and also ongoing worries about tariffs and the broader economy. Uncertainty.
Okay, so unavoidable headwinds, as the source calls them. Yet they also label Old Dominion best in class. How can it be best in class during a freight recession?
That's the interesting part. The analysis points to its ROIC, return on invested capital, being consistently higher than its competitors, industry-leading, in fact.
So even when times are tough, they're more profitable with their investments than others.
Precisely. It shows, according to the source, that management is really sharp. They keep taking market share, adding new service centers, and doing it very profitably, even now. That operational excellence really sets them apart.
And does that operational excellence translate into financial advantages during downturns?
Absolutely. They have a top-tier profit margin. That extra profitability gives them flexibility.
Flexibility, huh?
Well, it lets them do things like repurchase shares when the stock price is down, which they are doing right now, taking advantage of the dip.
Sure.
And it positions them to ramp up dividend payments more quickly than competitors once the freight market improves.
Right. Speaking of shares and dividends,
Yeah.
what's the picture there? You mentioned buybacks.
They've been quite active. Over the last 10 years, they've actually removed more than 1/6 of their total shares from the market through these buybacks.
Wow, that's significant shareholder return right there.
It is. Now, the current dividend yield is low, only about 0.6%.
Okay, seems small.
It does seem small up front, but look at the growth. It's grown by 33% annually over the last 5 years.
33% growth. Okay, that's huge.
It is. And like Pool Corp, the payout ratio is very low, only uses about 27% of their free cash flow.
So again, lots of safety and massive room for future increases when the cycle turns.
Exactly. Tons of potential for future dividend growth, which again fits that profile of a resilient long-term core holding candidate that can weather cycles.
So for Old Dominion, it's about best-in-class operations, leading to superior profitability, allowing them to return cash via buybacks now and setting up strong dividend growth later, even during an industry recession.
That captures the essence of the argument, yes.
Okay, so let's pull this all together. What does this mean for you, our learner? We've looked at Zoetis, Pool Corp, Old Dominion Freight Line, each facing headwinds, each down significantly from highs, but each presented by the author as a potential opportunity through this specific core holding lens.
And the common thread really is what the analysis highlights. These seem to be businesses with strong underlying characteristics, high returns on capital, good cash flow, solid market positions.
Like fundamentally sound.
Fundamentally sound, yeah.
Yeah.
But they're facing what the source views as temporary downturns or valuation corrections, and that leads to what the author considers attractive entry points, both on valuation and dividend yield potential, for building that long-term resilient portfolio.
So, quick recap takeaways. Zoetis, benefiting from pet humanization, maybe offering value after a valuation reset. Pool Corp, finding stability in maintenance sales during a housing slump. And Old Dominion, using its efficiency to navigate a freight recession and position for recovery.
That sums it up well, and the analysis is clear. Knowing exactly when the cycle will turn for companies like Pool Corp or Old Dominion is, well, impossible to know.
Right. Timing the market is tough.
Always is. But the source expresses confidence in their long-term resilience, their ability to come out stronger on the other side, which, raises a really important question for you to think about.
Okay, let's hear it.
Well,
how do you, the informed learner, tell the difference between a temporary dip in a great company like the ones discussed today and the start of a more serious long-term decline, perhaps caused by structural problems?
exactly.
What other factors, maybe beyond the metrics we talk about, might you need to consider when making that kind of judgment for your own understanding, for building your own core portfolio?
It's a critical distinction to make.
Definitely something to chew on. We really encourage you to continue your own deep dives into these fascinating companies and concepts.